presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Asset Management YouTube update for January the 11th, 2023. Let's start with the markets, and we're going to take a look at all of these markets and see. Start with the Fed. That's the expectation. We are expecting inflation numbers to be reported tomorrow, and that's going to be the big driver of the Fed, which has been the driver of the economy and the stock market. Take a look at the market, what's going on with the economy, and then my weekly technical analysis and the outlook for the week ahead. Let's start with what the Fed is thinking. Expectations still at 5%. That's where the Fed is going to stop. We are between 4.25 and 4.5% right now. So somewhere around two more 25-point increases is what is expected. Now, are we going to get more than that? I don't know. So two more 25-point increases are expected. I think we are just about there now. That's about what is expected. Some people are saying we need more. Some people are saying we need less. But it all depends on inflation. And if you tuned into the daily broadcast lately, I've talked about how inflation is coming down a lot faster than the Fed is expecting. Just like inflation went up a lot faster than the Fed expected in 2020 and 2021. Now I think it's coming down a lot faster than what is expected. If we get the year-on-year numbers, we expect it to be around 6.5%, the number we get tomorrow. A number lower than 6.5 or 6.4 is going to be bullish for the market. Number higher than 6.6 is going to be bearish for the market. There's a 65% probability between 6.4 and 6.6 is where the number should be for inflation. That's a year-on-year, adding all the yearly increases for the last year, taking a 12-month. But if you take a 3-month number, inflation is running somewhere around 3%. So it's coming down a lot. If we take just the recent numbers rather than adding the entire 12 months, we get a much slower inflation, lower inflation number. What that means is the Fed is again overdoing the interest rate increases, and they'll realize it when it's too late, because the economy, they'll push it until they break it. And that's unfortunately the situation it could be. I think the Fed will realize the 25-point increase, basis point increase, or 1/4% that is expected on February 1st. And then they'll sit around and see. If inflation continues to drop, for the last year I've said that we need unemployment to go up. But if we can bring inflation down without unemployment going up, I think the Fed will be okay with that, as long as we get inflation down. But do we need to get the unemployment going up? I think we need to have some pressure. The last week's wage numbers we got, wage increases were lower than expected, and that's why the market went up. Financial conditions are starting to ease. As you can see right here, they have come down quite a bit, and that's what I think they will continue to do. The market, again, interest rates have peaked right here, and they have started to come down. And that is where the market leads the Fed. The Fed has been following the market. The interest rates went up a lot before the market, the Fed raised interest rates last year. Now the market has come down from somewhere around 3.4% where we were for the 10-year, we're down to, or 4.4 down to 3.5, 3.6 is where we're fluctuating. So the market is telling us that the economy is going to slow, that inflation is going to slow, the bond market is, and the market is always right. The Fed always follows the market. Again, we are seeing strong unemployment data. That the dollar is still higher, but I believe the dollar is also starting to roll over. As the dollar goes down, for the last 10 to 15 years, we've seen one of the biggest declines we've seen, or the disparity we've seen, is between the S&P and emerging markets. If the dollar rolls over, I think that's going to be good. Inflation will come down because of the lower dollar, and it will also put upward pressure on the emerging markets, something to keep in mind. As far as the economy is concerned, job openings, there's still a lot more job openings than workers out there. But again, we're starting to see these job opening numbers roll over, and that is a good sign. Labor participation rate, we are seeing people starting to realize people who stopped working during COVID thought they could retire. The market went down in 2022. They realized, oh, wait a minute, I might not be able to retire. So they're coming back to work. So we're seeing people starting to realize that they need to get back to work before the jobs disappear. Don't forget to tune in to the daily edition of Market Wrap, a 1-hour broadcast every single day. And you can download the app simply by going to the App Store and typing in this entire Market Wrap with Mo and Ansari. One word, type that in. The app will show up, download it to your iPhone, and it is absolutely free, and you get the daily edition of Market Wrap every day. Looking at the technicals, we got above the 50-day moving average on the 50-day on the 10-year, but then we fell back down again. Support is going to be around 3.2%, resistance around 3.25%, and we are right in the middle right now at 3.55 is where we're sitting. The bond market is always right, so we'll have to wait and see and what it is telling us. S&P, it got above, touched the 200-day right here, fell off from there, touched it again, fell off from there, but now we're really close. We got above the 50-day, gapped up today. If we can get above the 39.87 or 4,000 area and stay there, that could be very bullish and indicate, okay, we finally made a bottom in the market. Finally, the interest rates might pause, the Fed might pause, and the market might anticipate that and take off. A lot will depend on tomorrow's inflation number. Looking at the weekly charts, again, resistance at 38.58. We're above that now. We're at 39.61. Looking at the next resistance is the 50-week moving average, 4,047, and then the long term at 42.03. NASDAQ looking much, much better after, failing to get above the 50-day, or this is the S&P daily chart. Sorry about that. The weekly chart for the NASDAQ looking a lot better. Here's the daily chart. We are coming back up. Here's the 20-week moving average and 11,075. We are at 10,901. So we need to get above another 200 points to get above first resistance. My dot plot, it is at 11,545. Once the market gets above these dots, it is in a bullish mode. Once it is below these dots, it is in a bearish mode. You can see that it was below these dots, got above it right here, which was April of 2020, right here, and stayed above when we got above it in April of 2020, stayed above it. The market stayed above it, and that's above all these dots, and that's a bullish sign. You can see at the beginning of this year, just at the first week of this year, the dots went above the market, and that showed we're in a bearish mode. Market came down. It got above it for a few weeks right here, which was a false breakout. It looked like in the summer it had made a top, came back down, made another low, and it has been lower since. But we're getting closer. If we can get above this 11,545, that'll change my long-term trend to a bullish trend for the NASDAQ. And oil is stuck between the euphoria that we had, oh my God, China is opening, to oh my God, China is getting COVID. So I think China will see the wave of COVID. It'll take some time for that wave to dissipate, and it'll take some time for them to get to herd immunity. Could be 3 to 6 months. So the reopening of China, I think, will be delayed before we see a complete reopening, even though now the government has removed all the restrictions and people can travel, etc. But people themselves, when they realize they're getting sick, are going to take precautionary measures, and they're not going to be completely ready to go to work until COVID subsides there. Gold chart. The gold is something that's interesting, that looks like it has made a long-term bottom right here. And one thing we're starting to see is China reopens and India is starting to buy a lot more gold. Central banks around the world are starting to buy gold for a reserve. And just like Russia had bought $300 billion worth of gold as a reserve, and they had $300 billion in banks around the world, those were frozen, that $300 billion, but the gold was still there, and they are trying to liquefy that gold. Chinese government central bank is starting to do the same thing. Instead of buying treasury bonds from the United States for safe money, they're starting to increase their gold holdings. China also, for the last 2 years, has been unable to buy gold. A lot of people, because of COVID restrictions. As they remove COVID restrictions, gold could be. And as we see interest rates peak and roll over, that could also be bullish for the gold market. So I'm looking for a long-term uptrend in the gold. Yes, we have come up from the 1620 all the way up to here, where we're about 1880 now. Any pullbacks down to around the 1830, 40, 50 area, I see that as a buying opportunity for the gold for the long term, where I think gold could be something that I have not looked at for the last 10 years or so. It has not gone anywhere, but I think a time has come to take a look at the gold market. It could be something to take a small portion of your portfolio. Those are my views. Those are my thoughts. And don't forget to sign up for Mo's Market Minute, a weekly newsletter that goes out every week. Outlook for the week ahead. I think the biggest number is going to be tomorrow when we get the inflation data. If it is below 6.4, expect a big rally in the market. Those are my views. Those are my thoughts. Again, if you need help with your portfolio, you can always go to compak.com, compak.com. I will do a 2-hour webinar on the January 24th. Just go to compak.com and you can register there. Also, if you would like to come and get help with your portfolios, you can always give us a call, make an appointment, and stop by the office. I'm Mo Ansari. I will be back again for the next update, the YouTube update for Compak Asset Management.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.